So in today's video, what I want to talk about is when you should consider to actually invest in different asset classes within your portfolios. That includes real estate, it's going to include stocks, and it's going to include non-correlated or risk-averse assets such as bonds and whatnot. What we want to hopefully do is illustrate how the economy and the different business cycle will affect the price of assets and when you should consider to actually take advantage of different asset classes throughout that cycle. Okay, so hopefully everyone can understand and see this visual. It's a little bit more complicated and hopefully it's not overwhelming, but we're going to walk through how each asset class, when it bottoms out, and then actually when it's an opportune time to sell. And so it all is based around the economy. So as you can see, this dotted line, that represents the actual economy. And so what I mean by the economy is that's the actual strength of the employment market, business growth, productivity, really just the whole lifeblood of kind of money. And so as you can see, it's going to ebb and flow as we go through different cycles. So this represents from this point to this point is really one business cycle. And so if you consider here, we would have this would have been like February 2020, so kind of the peak. Now what's interesting is the market itself, actually the stock market, which is represented by this pink line, actually trades forecasting based on the economy. So what's interesting is as you got into this coronavirus epidemic, what you actually notice is the market traded far lower, quicker than the actual economy has the real true effect. So for an example, in late February, early March, the market completely tanked. We didn't even really understand, we still don't even understand what the real true effect on the actual economy will be. And so as a result, that lags. Now why that's an important differentiator is that as the economy starts to bottom out, the market actually will trade ahead of what the economic results are. So what's hard for most clients to understand is that right here, where you get the low point in the market, is actually not the low point of the economy. And more often than not, the stock market will actually increase in value right around the low point economically. And why that is because the market is looking forward. So it's looking from this point forward, and it actually sees in the future economic activity improve, production improve, employment, etc. Now let's shift gears and let's take a look at what the non-correlated assets would do. So that would be things that the market floods to when equity markets and stocks become unfavorable. So that would be gold, US treasuries, US dollars, bonds, etc. As you can see, they trade almost inversely to what the actual market does. So if this is the stock market low, you can almost see where the high of non-correlated assets. Now it's not perfect, but the trend result is exactly the same. And as we continue to progress through the economy, as you can see that once you're at a low point in the economy, the actual underlying assets are trading unfavorably, which is hard to understand. More often than not, people would think, why would non-correlated assets like bonds and gold and risk-averse assets trade poorly when the economy is at its lowest? And that's because markets, all of these publicly traded securities, always look forward when they're considering how to price their assets. So now, on the contrary, let's take a look at something like a hard asset like real estate. So here would be an example. It trades lagging the economy. So you can see how asset prices, and that's why real estate prices really haven't been affected yet. Once we start to see the effect of the actual economy, that is when you're going to start to see real estate in this dark purple line start to come down. Now what's interesting is in order for real estate prices to increase, we actually have to see growth in the underlying economy. And it will always lag the productivity, income growth, and business growth of the actual economies itself. So as you can see, as the economy starts to progress through the business cycle, the best time to actually own stocks is not when you get to the worst part of the economy, but when you get to a point quite early, and we might have actually hit it on March 18th, but where you actually have fears of the economy or the future economy at its greatest level. And that would have possibly been in, say, mid to late March. Now, can it go later and lower? Yes, but in theory, this is the business cycle. So that's when you would want to step into the actual stock market. When you would want to sell your non-correlated assets is exactly in the opposite fashion. So your bonds, gold, treasuries, etc., you're actually going to want to sell them when the market is at its lowest, because those assets are going to be forecasting future markets as well. Real estate, on the other hand, and this is where we get a lot of questions from clients. They're asking, especially real estate investors, we're going to wait for a housing opportunity. They have cash on the sidelines. They want to take advantage of this. You have to be patient and allow the actual underlying economy to be at its worst level or its worst circumstance before you start to investing in real estate. Because this lag that happens is from lack of jobs, lack of productivity, lack of business growth, but will improve over time as the business cycle progresses. That's when you can see the upward trend. The biggest mistake most clients will do is they'll think that this market correction represents the worst part of the economy, but it's not. The worst part of the economy is yet to come. And that's where hard assets and business assets will actually trade on a private basis. So private real estate, private business, etc. Whereas stock markets will actually improve and almost be at their highest levels, ironically, when the economy is at its lowest. Take into example, in 2009, we didn't see the bottom of the unemployment and the productivity of the overall economy until we actually got to about 2011, 2012. And ironically, that's where the market had ramped right up to, almost had shot up from low 2009 levels back up to very high levels in 2012. Subsequently, real estate from 2012 onward did remarkably well because it was the later part of the economic cycle. So hopefully that wasn't too confusing. If there's any questions, please leave comments below. We're happy to clarify, even reach out to us directly, and we're happy to emphasize this. But really, you can see the different levels and how the economy progresses. It starts with the market, then it turns into the economy, then it turns into hard assets such as real estate. And you cannot change this sequence. It is time tested for really the history of markets. And so hopefully this information will help you assess when the best time is to step into all these different asset classes.